this, let me hand over the charge to our moderator, Maitri Sangoi, for starting the panel discussion. Over to you, Maitri.
Thank you, sir. Thank you, ma'am, for your valuable time. First of all, I would like to thank ICAI for this opportunity. And since this is the season for tax audit, I'm sure everyone has a lot of questions and queries. So we've received a few questions from the participants and we'll start from there. But in case anyone has any query or question which is going on and they would like to, ask, they can do that. So we'll start with the first question for, yes. Yes, clause 44 is done. We won't cover that.
We are not talking for clause 44 now.
Yeah, but this is for the rest of the clauses and general queries that people have. I'd like to start with the first question and I'll pose it to CA Gautam. Is a tax audit required if turnover exceeds the specified limit, but total income is below the maximum exemption limit?
At the outset, let me thank WIRC Ketan Bhai for inviting us on this subject of panel discussion on the important clauses of tax audit. Coming back to the question is whether, assuming the income is below threshold limit, whether the tax audit is applicable or no. Under the Income Tax Act, Section 44AB is the charging provision where the powers of tax audit is something which comes from. 44AB has 5 limbs, Clause A to Clause E. None of the clauses from A to E refer to minimum taxable limits, the minimum income which is subjected to tax. The applicability is assuming if you are in the business, your turnover exceeds 1 crore, tax audit is applicable. If you come under Clause B, which is the profession, then again 50 lakh is the limit. Then the presumptive taxation and specified businesses like 44, the oil and gas and all those sectors. So it has got nothing to do with the income chargeable to tax. Once you cross the basic threshold limit of turnover or gross receipt which has been prescribed under Section 44AB, then you would be subjected to tax audit. Thank you.
I think just to add further about this maximum exemption limit, I think all this gamut will come for 44AD and not 44AB as rightly laws. I will keep that for Gautam. I am a hardcore auditor and not a tax practitioner or tax consultant. I would try to share as much as knowledge which I have gained over the periods and my practical or personal experience during these discussions. So yeah, the question is pretty simple. All of us know that 5% cash threshold. I think the only catch here would be 5% of total receipts and payments. And what is receipts and payments? According to me, everything is receipts and payments except for what I include, may it be cash or bank, except for what we exclude is contra entries because that is something which is not receipt or payment. One cannot receive from himself or one cannot pay himself. So those are the transactions which one has to exclude or eliminate. Come up with some number, decide basis that number, 5% crossing the threshold or no, and accordingly you'll have to decide whether applicable or no. Would you want to add anything, Gautam? Any other questions on this specifically?
So we also have a few areas where we would like to know if these items are included in the gross receipt or sales turnover for determining whether a company is liable for tax audit. So I think CA Gautam can take them. The first is whether advance received from customers has to be included.
Yeah, it has to be included. It would be your normal trading business receipts, so it has to be included.
The second is sale.
I just want to add on this specifically. Now, typically, this situation can come in case of builders, developers, clients. That's where you'll have to be very careful, irrespective of whatever revenue recognition method you are following for your books of accounts. If there are advance received, then yes, definitely, as Gautam rightly said, it will trigger the threshold of gross receipts. So this is one practical example which I could think.
The second is sale proceeds received from fixed assets.
I think we already discussed sale proceeds from fixed assets would not form part of your turnover and gross receipts. And also, the institute has given an exhaustive list. If you refer the guidance note, I think all these pointers are already there in the guidance note where very specifically they have mentioned that these are the items to be considered for the purpose of turnover and these are the items which have to be excluded for the purpose of turnover. Let her complete and then we can come up.
The next is sale proceeds of property which are held as investment properties.
So again, this is more like a capital asset which you are disposing of. So it's not part of your routine day-to-day operations, so would not be considered as part of turnover or gross receipts.
The fourth is out-of-pocket expenses.
This is something which is critical and important. It depends. So there is no straightjacket answer for out-of-pocket expense. Yeah, it will depend upon the method of accounting that you are following. So assuming you are raising a consolidated bill to the client and he is paying you including your fees plus the out-of-pocket expense, and there is no separate bifurcation in the invoice, and it is received in the same bank account as your normal fees, then what the guidance note says there, that has to be considered as part of turnover. However, if a separate debit note has been raised and which gets parked as a separate money in a separate bank account, then probably that out-of-pocket expense would not be considered as part of gross receipts or turnover. The objective is that has to be specifically earmarked for that purpose. If you are raising a consolidated invoice, there is no separate bifurcation which is available, and that's the reason they say it has to be considered for the purpose of turnover.
And the last one is whether we have to include GST.
Again, a tricky one. So again, this will depend upon the method of accounting that one follows. There are diverse views on this, maybe within the participants and the speakers, or
Within the panel also,
So there would be diverse view which would be available on this. So at one hand, you have section 145A, which governs the method of accounting, where it says that what you need to follow is the inclusive method of accounting. When you come to your books of accounts, basically your AS 9, your AS 2 very specifically says that whatever taxes, duties on which you are entitled to get credit cannot be forming part of your sales or forming part of your inventories. There is a Bombay High Court judgment. I don't recollect the specific citation, but very specifically Bombay High Court has held that GST is something which is part of your, though it is not part of the turnover, but it still constitutes part of your gross receipts. Once it forms part of the gross receipts, the section of 44AB clause A very specifically says that turnover or gross receipts exceeding 1 crore. Because GST will form part of the gross receipt, it has to be considered irrespective of the method of accounting that you follow in your books of account. This would be very critical for cases where assuming the turnover is say 9 crores, and if you add the GST, it becomes 10 crore 25 lakhs. In that case, what is the position that you will take? Or assuming you say your turnover is say 1 crore 7.
Determine whether this is a turnover or no. So 100 profit, 50 loss. So net is 50. But I would say no, for my turnover 100 plus 50. So my turnover is 150.
The second is how to determine turnover for non-speculative transactions, like in the case of F&O.
I think same thing applies there also in case of futures. Option, there is one small catch is now that even premium amounts has to be considered as a part of turnover. So this is one additional change which happened in the last guidance note from the institute. Otherwise, this squarely falls as normal speculation or F&O business.
Just to add, the last guidance note, what it recommended was, the earlier position was that whatever is a net profit and loss would be considered as part of the turnover. However, in the certain reports that were getting generated, the premium amount that was received was not forming part of the total P&L figure that was getting reflected in that report. So in the last guidance note, there was specifically inclusion that premium that you receive would be considered as the part of turnover. However, in a situation where your net profit and loss that is determined by that report is already factoring in that option premium amount, then you don't have to add it twice. It is only to be added once. If the report is considering the premium received amount, then you don't have to do anything. If the report is not factoring in the premium received, only then you have to add the premium received separately.
And determination of turnover in respect of delivery-based transactions.
So yeah, as we agreed few minutes back, I mean, it will be gross value of purchase and sales, and those will be considered as a part of your turnover.
Any questions regarding?
Yeah.
Yeah, thank you, sir. I have a question. If a person is having income from other sources, and major income from intraday, no other income. And his intraday transactions are, say, running more than 3,000 rows in Excel sheet. So the report that we get from, say, Zerodha or someone, can that report be considered as books of accounts? Because they ask, if we, intraday is business income, so they ask whether books of accounts are maintained or not. So those reports in Excel can be considered as books of accounts, because virtually they have all the details, but not in Tally or something.
I think yes, I would tend to believe that, see, in terms of the books of accounts, you are liable to maintain books of accounts because your limit, whatever is prescribed under 44AA, you are exceeding that threshold limit.
Yeah.
But what books of
44AB.
I think there is no restriction or there is nothing like if for 44AB person has to be a resident or a non-resident. So the answer is pretty clear. It will be definitely applicable.
Any questions from the audience? Next question, whether to comply with revised SA 700 while issuing from Form 3CA or 3CB?
SSM. All right. So Form 3CA or 3CB, now department has come up with specific format or structure or the content of the Form 3CA, 3CB. But while we issue the audit report, the question here is whether SA 700, which generally guides that in our audit report, management responsibility or auditors or a practitioner's responsibility paragraph has to be there, whichever assurance reports which we are issuing. So this is a relevant question that in case of 3CB and 3CA, what do? Do we still comply with SA 700 or we simply issue the formats in which the departments are issuing the form? So my answer is yes, we'll have to modify Form 3CA, 3CB to the extent of management's responsibility and practitioner's responsibility and accordingly issue the reports. There is a practical challenge here when it comes to uploading or the utilities. Now there are no, there is no possibility where you can add those paragraphs or no. Practically what we are doing there is we are inserting one paragraph on our printout above saying that for all practical purposes, the physical audit reports have to be considered because there are some reporting challenges or reporting issues as far as the utility is concerned. So these are the practical calls which we have taken at our office, whereby we, even in case of many qualifications, there is a possibility that you may not be able to add any comments in your utility files, which we include as a part of our physical copies, and then we upload those copies as a part of uploading file.
Just to add on, in 2019, at the institute level, there was a formation of Quality Review Board for Tax Audits, which is called as TQRB. Now, TQRB had issued a report somewhere in 2021, trying to list down the errors which are commonly observed in the tax audit report. The publication is out. It is known as compliance reporting under the tax audit. In that, they have very specifically and categorically mentioned that in Form 3CA, the point number 3, the bullet number 3, that is where you need to mention the paragraphs of SA 700. And in Form number 3CB, it is the point number 5 of that 3CB where you need to mention the paragraphs of SA 700. So I would rather request everyone to go through that publication which has been issued by the TQRB, where clause by clause they have mentioned what are the errors which are common.
Unless that has been accepted by the SSE, in my view, it is not considered as furnished. A similar view has been taken in guidance mode, and Institute has clarified that actual acceptance of the date by SSE has to be considered as the furnishing date.
I think this question has also got relevance because I think in last couple of years post the UDIN being there in existence, what people have done is people have generated tax audit UDINs, but have actually not uploaded their tax audit reports. The issue now become, people can say I have already generated UDIN, it was only by error that this has not got uploaded. So whether this would technically mean that I am absolved of the liability which is there under section 271B of non-furnishing of tax audit report. The institute has said very categorically that unless the report is uploaded on the e-portal and accepted, it cannot be said to be furnished. The moment it is accepted by the client, because Form 3CD is basically the data of the client and you have to report in Form 3CA or 3CB. So unless both the parties accept to that position, the audit report is not said to be furnished.
Next question is whether a tax audit report can be revised, and if yes, then what is the timeline for revision?
So under the e-utility format, earlier there was no concept of revision, though the concept of revision was there under the guidance note. Practically, you never saw anyone revising the tax audit reports. It is only post 143.1 where you found adjustments in your 143.1, where by virtue of 43B, because you completed your tax audit report on say 15th of August, the client uploaded his tax computation or return of income on say 15th of October. During this period, whatever 43B payments were made were claimed in the return of income. However, the tax audit report suggested something otherwise. What department started doing was, when they started processing their returns under 143.1, they only considered the figures which were reported in the tax audit report as something which was allowed under section 43B. Now to cover this kind of situation, they gave an option under rule 6G, where they specifically now provided that under specified scenarios, so one of the scenarios that they have mentioned is 43B. The other scenario could be where there is an amendment, retrospective amendment, by virtue of which you now need to take a different positions in your tax audit report. Or third could be the corporate action, something like merger, demerger, which has now revising your financial statements altogether. In such scenario, it is essential that you will have to revise your tax audit report. Currently, the time limit for revising the tax audit report is 1 year from the end of assessment year as per rule 6G. However, practically what we have seen is the e-utility is allowing even to upload the tax audit reports for as earlier as assessment year 18-19 or 17-18. So per se, there is no restriction in the online utility. However, the rule is very clear that there is a specified time limit under which you can revise the report. However, you need to ensure that when you are revising, you are also fulfilling the conditions which have been prescribed under specific standards of auditing for revisions of audit report and making appropriate disclosures in your Form 3CA and Form 3CB.
Yeah. Yes.
Can we have mic?
The point that you mentioned, Yogesh, relating to what is the law and what the utility actually permits. I have had a live case of one of my assessees where one of my, I can't say my article clerk, responsibility is mine because I signed the report. So instead of making a disallowance, at one time 40A, 1A, if I remember rightly, was 100% disallowance. So instead of putting the disallowance under 30% rule, instead of putting it under 40A 1A, which is 30%, he put the disallowance in 40A, where it got disallowed at 100%. And this came out during the course of the assessment, scrutiny assessment, under 143.3. And by virtue of the disallowance, the loss was getting converted into a profit. Apart from the fact that there would have been tax implications and all that. So the client came back rushing to us saying that, sir, ऐसा हो गया है, आपने गलती से 40A में डाला, 40A वाने के बदल. And if I remember rightly, it was a year or so earlier, and the assessment was for 2 years prior or whatever. And then we went back and said that, can we revise the tax audit return report, and which we did that. And therefore, I think what you're saying in terms of the utility, permitting you to do something which is beyond what is actually the provisions of the law, I have a live example of that.
No, so even
Thank you.
Even in one of our client case, now that all of us as are aware, because of this 43B, officers are insisting to get these returns, audit reports revised. But exceptionally, in one of our clients' case, there was some other reason also where officers were really insisting to get this tax audit reports revised. So one will have to be careful while revising.
Return is reprocessed subsequently. In that subsequent reprocessing, that default will get deleted.
That means whatever we have reported in tax audit report will prevail.
That is what I said.
Typically, what it happens right now, अगर जो आपने कुछ टैक्स ऑडिट में गलत किया है तो गलत प्रॉब्लम है, आई मीन सीए का प्रॉब्लम है, बट आज की तारीख में प्रोसेसिंग ऐसे ही हो रहा है फॉर ऑल प्रैक्टिकल पर्पस. सॉरी, सिस्टम बेस्ड. या somebody had question there.
So while he was asking the question, what I understood regarding his query was, let's say there is a situation in which I have put a wrong rate of depreciation in my 3CD. I have corrected in my ITR. In that situation, Rule 6G will not allow me to revise, because that is not one of the situation which permits me under Rule 6G to revise it.
I agree, because that is the error which is done by you as an auditor. And I agree with you to that extent.
I can still do a revision under tax
But
audit.
6G doesn't have this condition for a permissible
For
revision.
assuming there are any errors which have crept in, so even under your normal financials, if there are any error, by doing proper disclosures, you can always revisit your financials.
No.
I think same thing would apply for your normal tax audit report also. It is not that whatever limbs have been mentioned in Rule 6G, the revision is restricted to those three things. If there are apparent errors from looking at the tax audit, if you can make that the depreciation had to be allowed at 15% and you have put it in 10% block, obviously you have to revise your tax audit report.
Okay, so what I understand is, I mean, to give a true and fair view, irrespective of whatever may be the correction,
Not
it
true
is
and fair, the reporting requirement
True and
under
correct.
it's true and correct.
correct.
and
I correct
more
myself.
erroneous.
It's true and correct.
Yeah.
Okay, thank you.
We'll take the next question. Clause 4 of form number 3CD asks the auditor to disclose whether the assessee is liable to pay indirect taxes. How should the tax auditor ascertain the relevant indirect taxes applicable to the assessee?
So, I'm sure everyone would be aware of SA 250, which requires us as an auditor to ensure that all other laws which are prevailing or applicable to the entities, we have to take care of. So, considering those standard of auditing's applicability on the statutory auditor, we'll have to make sure and ensure that any other indirect taxes, irrespective of whether the assessee has taken the registration or no, and if it is applicable to the entity, we have to make the reporting. I think this is what the question is.
Next question.
Yeah, good.
How to report the conversion of a partnership into a company, whether 2 audit reports are required to be furnished?
I think there is no confusion here because these are 2 separate legal entities. Both the entities will have different PAN numbers. It is assumed that they would have, both the entities would have crossed the threshold limit of turnovers, which would require the audit. Keeping all those assumptions or facts in mind, yes, both the entities have to file the tax audit report.
I think just to add on to the question, though not relevant from tax audit perspective, it would be more relevant from the ITR perspective. What happens to your 43B deductions? What happens to your provision for doubtful debts which are written off in the subsequent entities? What happens to your TDS claims? What happens to income which is accrued in one entity and received in another entity? So all those accounting mismatches is something that you need to take proper precautions whenever there is a corporate action. Even in case of depreciation, what you need to factor in is, assuming there is a conversion which is there or any corporate event which is there, the 5th proviso to section 32 will get triggered. And by virtue of that, what is the provision? It says that the depreciation would be allowed on a pro rata basis on the number of days the asset was used by specified entity. So assuming 180 days was used by the partnership firm, the balance number of days was used by the corporate entity, and the total depreciation in the ratio of the number of days will get split in both the entities. So all these smaller points or smaller issues would be more relevant than the tax audit offense. Now, there has always been a controversy, what is the distinction between compounding of an offense vis-a-vis compounding fees? There have been various instances where people have settled their cases without admitting guilt. So there could be a situation where I have, say SEBI has come up with some order against me, but I don't want to litigate this, I want to buy peace. So I might enter into settlement terms with the SEBI, trying to state that let's close the matter over here. Rather than litigating or you proving me that I have done something wrong, I am ready to pay a lump sum compounding fee of an X rupees. I am not admitting that I am guilty, but just to ensure that I peace, I don't want to litigate this further. Now whether that fees that you pay would be in the nature of penalty or fines is a big question mark. Currently there are 3 tribunal decisions which are available on record where the tribunals have held that if you are paying any compounding fees where you have not admitted that you are guilty, if you admit that you are guilty and if you are paying compounding fees, then it is compounding of offense. But where the position is that you have not admitted that you are guilty and you are still paying compounding fees, in such a scenario, whatever payment that you make would be allowed as deduction. There are decisions of Sun Pharmaceutical, there is a decision in case of Anil Ambani, and there is a decision in the case of Reliance Shares and Securities. In all these 3 decisions, the main principle that is emerging is that all the 3 SSC made certain payments and claim that we are not guilty. It is only to buy peace we are making this settlement payment. And the payment was allowed as deduction. A thin line of differentiation that one needs to make. This would be very relevant for the current year because clause 21 very specifically requires you to report penalties and fines which are not allowed as deductions. In that scenario, something like, say, under the FEMA provisions, you need to pay compounding fees, or there are late submission fees which are there. What happens to that? Whether would be allowed as deduction, not allowed as deduction. So one needs to be very cautious because this is a clause which was not applicable till last year per se, which would now be applicable from the current year onwards. I think Yogesh bhai, if you have anything else. I was very much expecting this. I wanted somebody to speak on this. I would tend to take a position that the distinction that Supreme Court had made earlier of compensatory and penal would still hold good. I would tend to believe that interest or late penalty fee for furnishing late GST returns would still be considered as compensatory in nature and not penal in nature. So even if the rate of interest is higher, say 18% or 24%, still the base liability is more like compensating because you have furnished late, somebody else has got credit late, and that is the reason government is charging you extra. The per se character of that additional payment is not penal in nature, and therefore whatever payment that you make would be allowed as deduction. Just to give you an example, assuming this would be more commonly applicable, disallowed, your profit percentage would be 1%, but because you are disallowing the entire purchase, you will end up paying tax at much larger value. This is much more draconian than what we are discussing for interest. Can we have some mic, please? Sir had some question.
So I had 2 questions. One question you just answered about the new section about this in the 43B inclusion, that from even one day after the financial year, if you don't pay, if the outstanding on the 1st of April, the entire MSME outstanding is going to be disallowed. That you answered that question. That is done. Another question I had was on the interest part, sir. Now, what happens practically is that MSME interest is provided reluctantly by most clients, and they don't even deduct TDS on it. They're saying in any case it's going to be disallowed. So my question is that then what about the TDS default? Because of 20, not for non-deduction of tax, not the 100%, not 40A disallowance. Talking on the TDS disallowance, the TDS default.
I would tend to take a position that irrespective of whether that expenditure is allowed or no, your compliance with reference to TDS provisions for the payment that you do would still be liable. You would be still liable to deduct TDS and deposit with the government. Assuming you take a position that I don't want to make deposit because this is already getting disallowed. Yeah. Under section 201, you would still be considered as assessee in default.
Default, yes, yeah.
However, if you want to take a position, what you could do is you could file form 26A and take a position that the SSC has already offered this in his return of income, the opposite party, and take a declaration from him, then the liability would only get restricted to the interest component, which is from the day when you were supposed to deduct and pay to the government till the date this declaration is getting filed. Otherwise, the consequences could be far. So assuming if TDS officers wants to initiate penalty or prosecution, he can initiate on that front.
Yeah, on the 201.
On the 201,
Yeah,
yeah.
that because SS in default. So it's better to pay the 24% higher interest up to the date of by getting the declaration on 26. Am I right?
You
So, see, general tendency is this provision of MSME interest. I'm not sure you would have provided in your books of account, but how much would have he
Yes.
been provided in his
That's-
books of account?
That's another
So
problem.
this
yeah.
challenge of 26A can arise. Yeah, so sir said that wherever there is a specific SANVAT applicable on very specific products, say liquor or say tobacco and such products, then only those numbers have to be reported. GSTs and other numbers are not reportable. Any different view on this? So yes, I agree with sir, because SANVAT was a specific law, a specific regulations which was governed under excise regime. Now, typically, the basic understanding or a common understanding was anything where you take the credit was treated as SANVAT, but that's not the fact. SANVAT was governed by a specific rules and regulations, and hence, only those specific products which are now part of excise and the SANVAT is taken, those has to be reported. At our office for last 3 years, since the GST came, we had never reported GST under this paragraph. But parallelly, there were many other firms which are taking this view that since GST input credit is available, you need to report under this. Now, there was some confusion even from the department's end. So there was a difference between Form 3CD actual and the utility, wherein they were actually mentioning this word GST, and that's where this confusion was. But we maintained that stand, saying irrespective of whatever is mentioned in utility, because utility cannot govern the law or the form, and hence we refrain reporting those numbers and we stick to only SANVAT numbers. Would you want to add anything, Gautam? Here?
Also, we would like to welcome C. Arpit Kabra, WRC Chairman. Please, sir. We'll move on to the next question for clause 31D, reporting for 269T to be done by both recipient, that is the lender, and the payer, that is the borrower.
I think the reporting is quite clear. 269T is for repayment of the loan, including the interest amount. The reporting has to be done only by the person who has received the loan and who is now making a repayment of the loan. It is not to be done by the payee, it is to be done by the payer. The provisions are quite clear. The only dichotomy is whether you include the interest component while reporting the 269T or you only report the principal amount. There are divergent views over there whether interest has to be included or not to be included.
Practically what we are suggesting rather in this kind of situation is wherever interest is not cumulated for next year.
Can you just, Mishra ji, just display the QR code right away? That QR code is a wonderful tool. What we've done is, so suppose today Shalini madam has clicked all of you. She's our cameraman over here. She's clicked all of you. She's clicked us, she's clicked all of you. Now, for example, if you want to have your own photograph, you reach out to us, you reach out to Ketan Bhai, reach out to all of these people, but no more. Just scan that QR code, it will scan your face. And wherever you are in any of the photographs, you'll get it in front of you, you can download them. Absolutely artificial intelligence. It's an AI tool. So you can, just release these moments, spread it across on social media. If you like any of us, whatever they spoke, just mention that on your social media. Let people know that as chartered accountants, we're doing so many stuff and whatnot. So you just scan this QR code, register yourself, and therefore you're done. Small things, but yes, everywhere there's technology. So our all social media handles are live. Very soon we are launching our chatbots. Our websites are revamping. You'll see messages. For networking summit, you must have received WhatsApp through a bot. I don't know, with two options, register and, or do you want to know more? One of the very, very big programs that we had at Sara Star. So all of this this will happen, this will go on. UAE ka when we did a project Niryat series when we did UAE, so for UAE corporate tax now people have made absolute pendrive bots in pendrive. All you need to do is get data through a Google form or whatever form. Everything else will be done by a bot. So you don't have to really, bother. So while you are here or while you are anywhere, you can just work for Dubai, work for India, work for any jurisdiction that you want. So technology is massive, and being a techno aficionado that I am, we keep on trying to implement technology at every small little places. So come if you are interested, do join us. It's a huge moment for all of us that we are reveling into technology and empowering ourselves. More than happy to hear from you. Reach out to us. Let us know. Thank you.
Thank you so much, sir. I would just like to mention that as a young CA myself, it feels so good that we are under the leadership of such great people that I think ICAI or WRC is at a place where every CA can flourish now. I mean, we have resources for everyone and anyone. Thank you so much.
So any questions from participants, we can take that, otherwise.
If there are any questions from the participants regarding the panel discussion, yeah, we can take them.
Yeah, this is regarding clause 13 ICDS reporting, the ICDS deviation reporting rather. Suppose there's a situation where in certain industries, like again, come back to my mine industry that I have, that's a burning issues going on. There is a mine closure accounts that I don't know whether, whenever you take a mine, you need to make a provision for mine closure every year because your mining lease is for 20 years. And then within the 20 years, you're supposed to put the mine back as to what your mining plan is told. So there was a situation where the amount is pretty high every year. So it's to be deposited in an escrow account. So allowability is not a problem because you're actually physically paying in the escrow account. But the amount is not utilized. So the view taken by the audit committee is that this is just to probably boost up profit or whatever. This is just an escrow account right now, and not a provision. Okay, it's not a provision, but the tax team says that this is a provision which you're not going to get the money back, right? So it's an allowable expenditure. It's neither a tax, so it's not a 43B or not a stat tax or anything. It's just a payment for this thing. So when the deviation like this, so do we report in ICDS to say that this provision should have been made in the accounts? Number one. And number two, will it affect allowability? If I don't make the provision, I'll keep on adding the escrow account as an asset liability straight away. Asset. When the 20 years down the line, the entire amount will be given to the government and the entire amount will be charged at that point of time to the P&L. Because audit committee says it's a provision which will probably be disallowed in ICDS. But having been paid, it will be allowed in the income tax. So if I do this, what about the ICDS reporting part and what about the allowability part?
If I understand your question correctly, what you are trying to say is that you are depositing a certain amount in a separate escrow account.
Yes.
In the financials, you are not creating a separate provision. Or
That is the proposal. Since the amount is still not, it's an estimate given by the government, yeah.
So whatever, so provision is basically an estimate only.
In any case, yes.
Yeah, so irrespective of whether you are creating a provision in books of accounts or no, if the provision is worked out scientifically, if provision is meeting the test, okay, on a reliable basis, this amount is going to be spent. You could take reliance from Supreme Court decision in case of Bharat Earth Movers, the principles which have been laid down. Based on those, if provisions are meeting the scientific criteria, I think that should be an allowable expenditure, irrespective of whether ICDS is there or not there. Okay. Because if those provisions, if those expenditure is something that I am going to